Well, good evening, ladies and gentlemen, and welcome back to Foundations of Stocks and Options. We are here tonight in class number 2 of the infamous level 1, and that means we're going to be talking about support and resistance here this evening. I want to thank you for some of the great comments I got after the last class. It was, for those of you who are retake students, it was your first time to see that, and I got some really great emails from you guys. I really appreciate that. Tonight, here's our agenda. We're going to talk about the driving forces of market price change. What is it that drives the price of a stock? And what better day to be talking about price action than today after some 470 points down yesterday in the market and extreme volatility both yesterday and today, over 1,500 points during the last 3 weeks. It's been a great market volatility moment. And what does that mean? It means it's a great time to be talking about what is the true driving force of the market. So we'll talk about that. We're going to talk about support and resistance, and then we will move all that into some basic charting discussions. So let's get rolling here. I've got Archana with me as a moderator tonight, and I have Ray, but Ray, for whatever reason, is signed in under Josh's name. So if you get a message from Josh, it's actually Ray in disguise. All right, so those are your two moderators this evening, and I appreciate them being here with us. All right, let's talk about the driving forces of market price change. Who's brand new tonight? Or maybe you were brand new in the last class, but who is not a retake that I can pick on a little bit? I like to get the names in front of me so I know who's new versus who's kind of a retake student. So Catherine is brand new. So Catherine, I'm going to pick on you a little bit, and it's not because I dislike you. It's just because you're fresh blood, you know. Jeff is new, and I know I got more than that. John is new. So I got 3 guinea pigs. Joe, they're all J names. Anthony's new. All right, so I got a handful of guinea pigs here tonight, and boy, it's great to get fresh blood in here. I can beat y'all up and make you look like you're giving the wrong answers. It's fun. But I promise at the other end of it, it'll all be worth it. So let's talk about the driving forces of market price change. If we ask the question about what a stock is, we define a stock simply by saying it's a share of ownership in a company. And of course, a share of ownership can be public or private. If we had a publicly held company, well, anybody can trade it. That's what you experience on the stock market in terms of the New York Stock Exchange and whatnot. If it's a private company, it's going to be more like, for example, our company, TradeSmart. TradeSmart is a privately held company, and consequently, there's only a few people that have any ownership in the business. That's the only difference. In both cases, you still have shares or divisions of ownership in the company. Now, because you have shares of ownership, those shares are tied into the equity or the value of that company, so those shares hold what we call monetary value. And of course, as the price of that company goes up, we can make a profit, and if the price of the company goes down, if you're holding the company as an owner, then you're going to lose profit. Now, we all kind of understand that. That's not rocket science. Even if you've never traded before, you kind of have a basic understanding of what a share of a company is, but the question comes to mind of what would cause the price of a stock to change. So some of my newbies here, Catherine and John, actually any of you can respond, but I want Catherine and John particularly to respond. If I were to ask you, Catherine and John, what causes the price of a stock to change, what would you say? What would any of you say would cause the price of a stock to change suddenly? John has written in, and he says the economy causes the price of a stock to change. Catherine says it's demand. Jeff suggests that it is demand. Edmund suggests it's speculation. Edmund's a retake. Tom suggests that it's emotion. Buyers and sellers says Wayne. Sentiment says Brian. World events says Dan. Good earnings came in from Tom. So here you see we've got a class. In our class, we've got about 100 people here tonight, and in this class we've got a lot of different opinions on what drives the price of a stock to change. So let me ask you, who's right? Who's right? Out of all these suggestions, all these opinions of what drives the price of a stock, who's right? And Catherine writes in that she's right. Of course, Catherine, there's other things you lie to yourself about too, right, dear? Just kidding. Anthony says they're all right. Well, let's ask the question about fundamentals. If I were to suggest to you that fundamental data drives the price of a stock, how many of you would agree with that statement? When I talk about fundamental factors, I'm talking about things like financial data, the overall economy. Maybe you might do some sector analysis and say, well, if the overall retail sector is doing well, then Walmart should do well. Or if the overall airlines are doing poorly, then, American Airlines should do poorly. Maybe you look at the leadership or the management of a company. If I think about fundamental factors, if I speak about fundamental factors, how many of you think initially, yes, those are key things that would drive the price of a stock? Go ahead, just confess it. If that's you, it's great. I just want to know who agrees with that statement. If you don't agree with it, then you can say no, or you can just not say anything. But if you agree with it, just type in something. So Anthony agrees with it. Jeff is on the fence there. Kenneth agrees with it. I think that's correct, says Catherine. All right, so a bunch of you are writing in. Some of you are saying no. Dan says that's part of it. Sometimes, says Debbie. So I got kind of a mix here. All right, well, let's go on a theoretical basis. Let's go in theory here, and I'm going to slow down because I want you to understand what I'm saying in theory. In theory, a stock's price should always return to its real or its intrinsic value. How many of you can agree with that statement? In theory. In theory, if you do the numbers and the company should be worth $80 a share, then if it's trading at $60 a share, in theory, it should return to its real value. Now, the reason I'm emphasizing this word in theory is because theory is not fact. What is theory? It is a theoretical assumption. What is fact? It is an actuality. So if we look at the fundamentals, the challenge that I want to propose to you from a pure fundamental standpoint is fundamentals build their argument on theory. The theory is, if we do all the number crunching, then a stock's price should return to its real intrinsic value. Now, that provides a whole lot of challenges. For example, which formula determines the real value? Brian said, yes, that theory sounds good, but Brian, if I ask you, if the theory sounds good, then Brian, I'm asking you now, the question is, how do we determine the real value? Is it a basis of leadership? Is it a basis of the business plan? Is it a basis of the earnings ratio? What determines the real value of a company? And unfortunately, I don't think any of us can sit here and say empirically that this data, A plus B, will equal C, and that will determine the real value of a company. In fact, there are hundreds of thousands, if not millions of people around the world that spend millions of hours and billions, if not trillions of dollars, crunching financial data to try to come up with an answer to this question: what is the real value of a stock? How many of you have spent hours looking at a stock, poring over the fundamental data, trying to answer the question, what should the price of this stock theoretically be worth? And after you've pored over that data, how many of you have then looked at the stock and say that price looks nothing like what I just came up with? It's a frustrating algorithm because the truth is, I don't know that anybody knows the answer. Trying to come up with this answer of the fundamental value takes a lot of work. It takes a lot of homework. It takes a lot of time. Each sector is oftentimes like learning to invest in an entirely different market. These are all struggles that the fundamental argument have, but maybe the biggest struggle that the fundamental argument from an investing standpoint has is the fact that true fundamentals are really only released 4 times a year. Right now, as we are learning in this webinar together, if you listen to the news, you're going to hear some interesting things that they are blaming the current, most recent 1,500-point sell-off on. What are some of the things that you've heard in the news lately? How about the Ebola scare? Okay, I don't know if Ebola is going to be a big deal or not. I know that there's a couple of people in the United States that have contracted this disease. I realize that it is scary for the people that are around it. I'm not making light of that. But are you really trying to tell me that the value of American Airlines is intrinsically built upon Ebola? The answer is no. However, whenever the market sells off, what does the news media do? They look out there and they say, what's going on? Oh, it's Ebola. It must be Ebola. And it's also the fear of ISIS. So why is it that today in October, ISIS is suddenly a threat to the United States economy, whereas back in June, when the market was plugging through all-time highs, ISIS was a non-issue? What's the difference? And the answer is there is no difference other than suddenly the market sold off and the news media needed to blame it on something. In reality, in actuality, true fundamental data is typically only released 4 times a year, with the exception of the occasional news release. Yesterday/this morning, it was last night after market hours, Netflix announced earnings. Netflix did not give the data that some people wanted, and this morning, Netflix gapped down, and I forget where we closed, but we gapped down like $80, and at one point I was looking at it, we were $90+ down. I think we may have rallied a little bit towards the end of the day, but that was a move that was based on earnings, not Ebola. Do you understand what I'm saying? We can look at the data of a company, and there's only a few times a year that hard data comes out. The rest of the time, it's just noise. And yet, if we're not careful, we will fall victim to that noise and we'll make really bad trading decisions based on that. So let's take a look here and let's go on our theory. Let's say that in theory, a stock will always trade to its real value. And if in theory, fundamental data is only released 4 times a year through the 4 earnings dates, then in theory, the price action of a stock should look something like this. Stock is chugging along at one price. We revalue as some new earnings come out, and now we valued, and now we're chugging along at this new price. No news has come out. There's not been any new data that comes out, and then boom, there's another earnings date. Okay, stock revalues, boom, now we chug along at this next price until we've got another earnings date, and boom, stock revalues. And in theory, if fundamentals were really driving the market, then in theory, do you think it would be true that the price action of a stock should look like this stair-step action that you see on the screen? How many of you think, in theory, that should be the way that stock pricing would work? I, for one, believe in theory this is how it would work. And I can prove that most people believe that in theory this is how it should work because if you are like most people have had a day when one of the stocks in their portfolio sold off radically during the day. Maybe it was a Google or a Netflix or something else, but for whatever reason, the stock sold off $15, $20 in one day, and you didn't see it coming, and what do? You go to Google and you search for it, and you say, Google, why did Google go down today? And you see there's no news to support this. All you see is Google's down $20 today. Why? I have no idea. So you go, well, of course Google's not going to respond, so let's go to Yahoo Finance. And you go into Yahoo Finance and you type it in. Why did Google go down today? Have you ever noticed what some of the most popular searches related to finances are? One of the most popular searches is, why is the Dow Jones down today? Go look for it yourself. If you want really good SEO rankings in the search engines, use why did the Dow Jones go down today in your title and you'll get better SEO rankings because people literally search for these things. How many of you have done that? And then what happens? You go home and you're all discouraged and your spouse says, why are you upset? And you say, my Google shares went down today $20 a share and I have no idea why. I searched Google Finance. I searched Yahoo Finance. I even did the worst thing of all. I went to Microsoft Finance and nobody had an answer for me. I have no idea why my Google shares are down $20. It should be higher. I thought this was a good buy. That's because in theory, we believe that the price of a stock should look something like what we see on the screen. But theory is not fact. What is fact? Edmund, if we're to talk about fact, what does the price action of a stock typically actually look like? It looks more like what I've just drawn on the screen. In fact, this is the actual price action of Baidu between 2010, 2012. It doesn't matter what time frame it is. It's just a chart that we threw up here. And while in theory, it seems like the dark black line, the stair-step action is what the price action of a stock should look like. In reality, the stock does something like this where it runs up and then it comes down and it runs up and it comes down and it comes up and it comes down. And it may or may not have any good reason for all of these big moves to be going on. And that, ladies and gentlemen, is the reason that you feel seasick whenever you study the stock market. And it's also the reason that traditional investing wisdom says, you know what, you can't time the market. We have no idea what's going on with the market, so we're just going to buy and hold and pray for the best. Because the truth is, nobody knows what's going on in price action. And it is that same philosophy that over the last 3 weeks has cost a lot of investors a lot of money, because they've been holding on. Many people right now, yesterday at the end of the day, today, many investors are buying on the quote-unquote dip, even though all of the data is telling us if you buy right now, you're playing with fire. But the traditional wisdom does not look at this squiggly line and say that is logical. The traditional wisdom says it should be this theory. Unfortunately, theory is not fact. So I'm going to ask a better question, Chris. Chris, what really drives the price change? What really drives a stock to move up or to move down, regardless of if it is logical or not? And I'm going to suggest to you that in theory, fundamentals should be true, but in fact, they have very little to play out on the market. How many of you believe that Ebola might be a problem? However, the fact that gas is the cheapest it has been in the last, 2 or 3 years would be better for airlines than the danger of Ebola? How many of you think that the gas price should be a good news story in theory for the airlines, as opposed to the scare that everybody is stirring up about this Ebola virus? Fundamentally speaking, the gas story is a bigger story. How many of you think that retail sales should go up because the price of gasoline has gone down? Here in Nashville right now, I just paid $2.98 a gallon. I'm thrilled. How many of you think that that should be a bigger story? And yet people are saying retail sales are probably going to be going down because maybe people are not going to want to shop because 2 people got sick with the virus. You see, the fundamental data says one thing, and we can just write this in your notes. We can just sum it up by saying fundamentals are theory. Fundamentals are theory, but actual price action is fact. And the actual price action can really only be pointed or be derived from one driving factor. What really drives the price change in a stock, whether it be up or down, is this key word right here that we call speculation. Speculation. It is speculative to assume that because this Ebola virus might spread, then people are going to stop flying, so we're going to sell the stock. It is speculative to assume that because a couple of people got sick, nobody's going to want to go buy iPads, so we're going to short all of the retail markets because retail traders aren't going to want to trade, aren't going to want to play. I said that sentence a little bit goofy, but you guys knew what I meant to say. Retail participants. People aren't going to want to go buy goods. They're not going to want to go to the mall. That's what I meant to say. The point is that it's a speculative assumption, and it is equally speculative to assume that because the price of gasoline has come down, airlines will be more profitable. It is equally speculative. It is also short-sighted to assume that because the price of gasoline has come down, people are going to have more money to spend. Because what we did not address is the reason that gasoline came down. Gasoline is coming down because the value of the dollar is going up. If the value of the dollar goes up, the commodities prices are going to come down. It appears that, hey, this is great. Commodity prices are down. We can buy gas cheaper. We can buy food cheaper. But here's the story that we don't necessarily talk about. If the dollar's going up, then we're running away from inflation and we're probably approaching deflation. And deflation may be a bigger problem than inflation. So consequently, the falling gas price, which is tied to the rising dollar, might actually be a bigger problem than we thought. Now, do you see the challenge of the fundamental argument? The challenge is, what is real? In reality, we can look at any of the fundamental data, and the decision to buy or to sell the stock ultimately comes down to this key word right here, speculation. What does Sean Tate, sitting in Brentwood, Tennessee, think this fundamental data is going to do to the price of this stock? It doesn't matter if he is right. If Sean and Robert and John and Tim and a bunch of the rest of the people in the room decide that this particular information is going to drive the price of the stock that way, they will all take that action, and consequently, their speculation becomes the driving factor of the stock, not the news itself, and certainly not the fundamentals itself. So let's ask a better quality question. If fundamentals don't really drive the price of a stock, if speculation is really the driving price of the stock, then I would like to ask this question of you, Catherine. What is the present value of a stock? What is the present value of a stock at any given time? And here's what I can suggest to all of you. The present value is today the exact same that it was yesterday and the exact same that it will be tomorrow. The present value never changes. The present value of any stock at any given time is the same as the present value of any futures contract or any Forex trade or any other item that is driven, or that is priced, I should say, in the free market. The present value of any given thing that we are trading is 100% dependent upon what someone is willing to pay for it. What someone is willing to pay for it. I've got a house around the corner from me here in my neighborhood. For some reason, they priced this house about $65,000 more than the rest of the houses in the neighborhood. I have no idea why they priced this house so expensive. It surprised me. I saw it went on the market. I looked it up just to see what they were asking for it. $65,000 more than the rest of the houses in the neighborhood. I said, why? Because they think someone's going to be willing to pay that. And yet, if you work in real estate, or if you've ever bought houses or sold houses, you understand that the value of that house may appraise for one value. It may be estimated at one value on Zillow, but you're only going to get the amount of money that someone's willing to pay for that house. And so what happens if gas prices come down, but gas prices are coming down because the dollar's going up, the dollar's going up because we're getting into a deflationary period? What happens to the price of houses? The price of houses start to go down. Why is the price of houses going down? Because the dollar is in high demand. If the dollar's in high demand, it has more buying power. If it has more buying power, then someone might just settle for $85,000 less instead of $65,000 more. Whatever the item is that we are trading in the free market, the present value is always what someone is willing to pay for it. So what are the real factors to price? If it really comes down to what someone's willing to pay for it, if it ultimately comes down to the driving factor of human speculation, then what is the real factor to the price of a stock? And the answer is simple. It's what the buyers and the sellers think about the stock. And we can sum that all up with this key vocabulary word that we call sentiment. Remember that word if you've never heard it before. Sentiment is simply what the buyers and the sellers think about the thing that they are buying or selling. Now, here's a question. If we're going to talk about the real factors to the price of the stock, we've deduced that it's down to what the buyers and the sellers think. Here's the next question you need to answer, Chris. Who are the buyers and the sellers? We've gone so far now in our logic that we've assumed and we've understood that fundamentals don't drive the market, it's speculation. And the current value of a stock is what someone's willing to pay for it. The real driving factor, the buyers and the sellers, and what they think, which we call sentiment. So who are those buyers and the sellers? And the answer, Chris, is people just like you, people just like Edmund, people just like Catherine. You've got institutional traders in there, but the research has shown that institutional traders aren't necessarily any more effective at trading the market than the average retail trader. I've been watching Fox Business and CNBC for the last couple of days. I always love a good roller coaster ride in the stock market, and I love watching people's opinions coming out on television. So I've been listening to these fund managers, and some of them just crack me up. Some of them are pretty smart people. And ironically, those smart people are the ones that are getting shunned on television because the sentiment is so strong in the traditional investing media that you buy the dip. And so you've got some reasonable people on television talking about reasonable issues, and they're getting shunned. And then, maybe 3-4 weeks into a major sell-off, suddenly those same people are back on television, and the commentators are saying, how did you see this coming? And the answer is simple. When you can put on a different set of lenses, you can see the market differently. That's what I want to teach you how to do. I want you to understand that whenever we talk about the pricing of a stock, what we're really talking about are human beings. It's not about the fundamentals of the company. It's frankly not about who's running the company. Yes, all of that can have an impact. But what really matters are the people who are the buyers and the sellers. And the good news about people is people are extremely predictable. How do I know people are predictable? Because people are driven by emotion. Now, if I were to say people are driven by emotion, how many of you would agree with that statement? How many of you would agree that people are driven by emotion? Well, let's just prove this a minute. If I were to say to you, Edmund, people are driven by two emotions. What are they? Fear and greed? Would you agree with that? If we think about the stock market, we think about the pricing of a stock. Does it really come down to fear and greed? And you see, you guys are so predictable that you've written in, I agree, yes, oh yes, absolutely, said Robert. Was that Robert? Yep, that was Robert. Fear and opportunity, says Tom. Edmund says yes, oh, I agree, said David. You guys are so predictable, you agreed. I set you up. This isn't even a true statement. And yet you all fell for it. Why did you fall for it? Because you've been conditioned to fall for it. Society's been conditioned that the stock market is driven by two emotions, fear and greed. And if we're honest, fear and greed are not equally paired emotions. In fact, I would suggest they're not even both emotions. Is greed really an emotion? Think about that. What is the opposite of greed? What is the opposite of greed? Maybe generosity? Probably generosity, benevolence. What else? Charity. Yeah, those all work. Fear is not the opposite of greed. What's the opposite of fear? Courage. Courage, confidence. So why in the world would we sit here and fall into a trap that says the market is ruled by the two emotions of fear and greed? Greed's not even an emotion. What is greed? Greed is a state of the soul, period. That's all it is. Greed's a state of the soul. And I can't make you be greedy. I can't make you be generous. You are going to be what you are. And yet what we hear from our politicians and we hear from the talking heads on televisions and oftentimes we hear from the preachers themselves, if you're making money in the stock market, then you're a greedy person. And I would suggest to you that greed is probably not why you are here. In fact, greed does not drive the stock market. Sure, there are a few people who are a little bit greedy. They're so rare that they make it onto television like Bernie Madoff. But to sit here and say that those greedy Wall Street investors are ruining everything is just flat out a false statement. A statement made from people who frankly are quite envious. What's the truth? Let's talk about the truth, Edmund. Why are you here? Why are you really here? You're here because you recognize that there's an opportunity to make money in the stock market. Is that a true statement? How many of you would agree that you're here because you want to make money? And if you are honest with yourself, how many of you would say you're truly greedy? Probably not very many of you. I always have one or two. But most of you would say, no, I'm not really that greedy. In fact, I love to give away stuff. It's one of my core needs. In fact, I feel great about myself when I give. If you're like most people, you have found that part of your spirit that says, I love to give. Contributing to people is a great gift. And so greed and generosity do not coexist in the same spirit because they're antithesis. So just get that out of your mind. Say, I'm not a greedy person. I'm an opportunist. I look at the stock market and I say, I've got the opportunity to go make some money. So what's really driving you? We've got two real emotions. One is the fear of loss of capital. See if I can write this straight on the screen. Loss of capital. And what's the other one? Fear of loss of opportunity. Really, we're driven by two emotions. Both of them are based in fear. The fear of loss of capital and the fear of loss of opportunity. Which one of these emotions do you think is stronger? The fear of loss of capital is so strong that when we get into a bear market, like we've been into the last 3 weeks, the market can sell off 1,500 points because people just suddenly say, no, I'm afraid I'm going to lose my money. Get me out of this trade. Get me out. And it creates a panic. That's what a dominating force, the fear of loss of capital is in the human's mind when it comes to trading. So what happens is we've got a little bit of a pendulum here. And let's just do a little balance beam over here. On one side, we've got the fear of loss of capital. We'll just call this fear of loss. And for the most part, the fear of loss at any given time is kind of like darkness. All you have to do is turn the light switch off, and there it is. It's right there again, right? So all you have to do is put a little bit of fear out there, and people are freaking out again. So you got the fear of loss of capital that drives most people. And then you got the fear of loss of opportunity, which flips over here, and it starts to look something like, we can call it opportunity. Probably a better word would be optimism. The balance of the two emotions of fear and optimism. This is what's really driving the stock market. How many of you can agree with that? Whenever you finally pull the trigger and you decide, yes, I'm going to go buy a stock, I'm going to go invest in this company, it's because in some way, in the depths of your mind, the emotion of optimism has outweighed the emotion of fear. Sometimes you might buy because of a fear of loss of opportunity, but most of the time, in order for someone to take the action of putting real money on a trade, it takes the optimism that this time it's going to be different. This time I finally got my courage up. This time the stock market's been going up for 5 years. I think it's finally time that I get into the trade. And then, of course, what happens? The day you get in is the top of the market, and that's when we get into a 1,500-point sell-off. And before you know it, the fear of loss is screaming at you again. How many of you can agree with this? How many of you understand this idea that I'm throwing out here? How many of you think that it's more realistic to say that the fear of loss of capital and the optimism of opportunity are much more of a dominant emotion in your decision-making than the two emotions of fear and greed? For 99% of the world, these are really the emotions that are driving your trade. Now, why do I even go into this? The reason I go into this is for a couple of reasons. Number one, if we're going to make money, we got to start dealing with fact. We can't deal with theory. We got to start dealing with fact. That's the first reason I go into this talk. The second reason is for some of you, it's a psychological barrier. For some of you, and I used to be there, by the way, but for some of you, you've spent your entire life with the story that if you make a lot of money, you're greedy. And as long as you believe that story, you will find a way to sabotage your money-making efforts because in your spirit, you know you're not greedy. And so they become incongruent. And so what I want you to kind of illuminate tonight is the idea that if you make money, it doesn't mean you're a greedy person. In fact, if you were greedy, you wouldn't be here. The reason you're here to learn how to trade is because you recognize that there's an opportunity and you're optimistic that you might be able to participate in some of that upside potential. And so if you're one of those people, and I've always got a small cross section, usually it's about 15 to 20% of my class, If you're one of those people that has struggled with that inner battle, I want to give you permission to let that go. I assure you, no one will make you a greedy person. The only person that can make you greedy is you. And if you happen to be the other person, if you happen to be the person who says, I am here because I'm greedy, then I just need to encourage you to go home because I can't help you. There is no amount of money that will quench your thirst for money. There's no amount of money that will quench it. And so if you're a truly greedy person, then there's nothing I can teach you that will help. But it's so rare that I get truly greedy individuals. And so hopefully this discussion has released some of you, and if nothing else, for the rest of you, hopefully it's illuminated the true emotions that are driving the market. Now, with that in mind, here's what we can deduce. We can say stocks are going to be predictable because people are predictable. People are so predictable that I can say, what are the two emotions people are ruled by? And you guys say fear and greed. It's predictable. It's like clockwork. I've done these classes for 6 years. I've never taught this lesson or any variation of this lesson and had people write something other than fear and greed. You're conditioned to respond that way. People are extremely predictable. And because people are predictable, it allows us an opportunity. I understand human behavior. And when we study the stock market from a technical standpoint, what we're really doing is we're studying the price action of the market as it's reflected in the price of the chart, which translated in reality means technical analysis is the study of human emotion as it's reflected in the stock market and as it's reflected in the price of a stock. I'm going to go a little bit slower here so you can write this down and let it sink in. Technical analysis is truly, in reality, the study of human emotion in the stock market as it is reflected in the price of the stock. Now, here's the benefit of technical analysis. When we talk about fundamental analysis, we're dealing with theory. But theory is not fact. What is fact? What's fact is the price action of the market itself, which will always be reflected in the chart. That's why we study technical analysis. Because technical analysis is the only form of analysis that has a mechanism of bringing into the information we study this component of speculation, this component of human emotion. And so the benefits we get when we talk about and we study technical analysis is, first and foremost, we are studying the most fundamental factor, the factor of human emotion. More importantly, we don't have to wait 4 times a year to get that data at quarterly earnings. We can get new information every minute of the day, every tick by tick, literally. At the end of the day, we've got a new set of data that we can make new analysis with and we can make new judgments with. It allows for a quick analysis. It does not require us going out and getting all this fundamental information. In fact, for those of you who've never traded with technical analysis, you're going to learn that all of the fundamental data that you've spent hours poring over, you've spent all the buttons on your calculators trying to calculate, all that fundamental data has already been summed up in the price action of the stock, and all that remains is the action itself driven by speculation and human emotion. Consequently, technical analysis is truly the most efficient way that we can analyze the market and predict prices. You say, well, how can we possibly predict prices based on technical analysis? And here's the answer. Because technical analysis reflects what? It reflects human emotion. And people are extremely predictable. Now, what I've just laid out for you is I've laid out an argument, I've laid out a discussion of why we choose to trade with technical information. Technical data gives us an edge that if you will learn to look at the technical data on its own, you will realize that the traders who are trading the stock are telling you a story. And it is a story of trading sentiment. And it is a story that can benefit us to the point where we can get into a trade before the rest of the market recognizes what's going on. It allows us to be able to be bearish on September the 20th after the market made its highest high just a few weeks ago, when the rest of the world was talking about how soon the Federal Reserve will increase interest rates and stop quantitative easing. It's the same information that 3 weeks later has allowed us to make substantial returns on our trades, while the rest of the world is wondering what just hit them upside the head with a baseball bat. And now suddenly, ironically, 3 weeks later, the conversation has turned from when will the Fed raise rates to, oh my goodness, look at how the dollar's been going up. Now the Fed can't raise rates. They've got to lower rates. They need to try to stimulate the economy. Maybe we're going to see more quantitative easing. What a joke. The fundamental argument that people have tried to rely on for years has been masked in terms of its success because of a grand market cycle that we've been in. It's a market cycle that's been in play. It's an 80-year cycle. I don't have time to go into it tonight, but I'll just tell you on its surface here, it's an 80-year cycle that basically reset around the time of the Great Depression. And that cycle ran basically through the end of the millennium, around to the year 2000. And right now we're in a corrective cycle of that. We've been in the middle of that for 10 years. And we've probably got another 5 to 10 years to go. And what that means is for the next 5 to 10 years, before we get to the next phase of that cycle, we're going to have continued volatility. The likes of 400-point swings in the market like we saw yesterday. And if we try to invest with fundamental information using the traditional story that if you just buy and hold and pray, eventually it will all go up, we're going to get slaughtered. But the benefit of using the technical analysis is right here in the chart. It tells us a story. And so as you look at this picture right here of Caterpillar, this is a pretty recent chart. Well, I lied. This was a year ago. Sorry. This ended back in ended December 13. And as you take a look at this picture here, how many of you see a story in Caterpillar immediately? If I were to say, what's the story that you see? What do you see? Robert, what do you see in this picture? Sophie, what do you see? Go ahead, just tell me. I'm going to pause a little bit here while some of you type out your story. What do you see the second you look at Caterpillar on this screen? Tim, do you have any stories that you see when you look at this picture? Do you think, oh, that's a wild ride? Back at the beginning of the year, we were really high, and then suddenly the stock sold off 20%, and then it rallied from $80 to $90 a share, and then it sold off back down to $81, $82, and then we had a rally, and then we kind of got stuck, and at the end of the year, this was a roller coaster that was depressing, that ended the year 10% down from where we started? Is that the story that you see? Catherine says she sees huge drops, ups and downs. Christy says she sees a rest after the decline. Sophie says she sees a consolidation. Leon says he sees it moving sideways. What if I told you that I see predictable human behavior? If I told you that I see predictable human behavior, do you think that it would be logical to theoretically go forward and say, if I can identify predictable human behavior, I could probably profit from that? Let me introduce you to two really, really valuable words. They are support and resistance. Support and resistance. What are these magical words? The first word, support, is going to be a term that we use to define the price point where a stock finds more buying pressure than selling pressure. And the buying pressure drives the price of the stock higher, thus creating a bullish situation. Support, the price point where a stock finds more buying pressure than selling pressure, and the buying pressure drives the price of the stock higher, thus creating a bullish situation. Resistance is the price point where a stock finds more selling pressure than buying pressure, and the selling pressure drives the price of the stock lower, thus creating a bearish situation. Learn these definitions, understand these principles, and you're going to unlock a world of opportunity in every trade that you look at. If you will learn these two key concepts that I'm going to be teaching you through the rest of the evening, you will be able to take any stock a stock you've never looked at before. And within just a few 15 or 20 minutes worth of time working with it, you'll be able to identify where the buying and the selling pressure is going to build. It's not based on fundamental data. It's based on human sentiment. Let's take a look over here at Caterpillar. If I were to look at this chart, I recognize that there's a lot of selling pressure every time that the price of the stock starts to go down. So we had selling pressure up here. We had selling pressure here. We had selling pressure here and over here. Now, do you notice anything interesting here? This selling pressure in the middle is kind of all about the same spot. It's not always precise to the penny, but generally speaking, somewhere between $88 and $90 a share, something magical happens where a lot of selling takes place. And if we were to look at the bottom, you're going to notice a similar phenomenon. Somewhere around $82 a share, sometimes dipping as low as about $80 a share. We have a whole bunch of buying pressure that starts to build. Now, why are the buyers buying at $80? I have no idea. Why are they selling at $88? I have no idea. And frankly, I don't care. Sometimes the most dangerous question we can ask is why. Chris, how often have you asked that question? Why did the stock go down? Why am I losing so much money? Sometimes that's the most dangerous question we can ask. My son asks me, Dad, why does the sun come up in the east? And I just say, don't sign up for that class, son. It just does. The earth just rotates and it just comes up in the east. I can't explain it. It's a mystery beyond myself. Chris, why do the buyers on Caterpillar show up at $82 and the sellers show up at $88? I have no clue. They just do. But here's what I do understand. Understanding that the buyers and the sellers show up at these price points, it doesn't matter why it happens. It just matters that it happens and that it's predictable. Understanding support and resistance helps us to define a certain range. And then what we can do, Chris, is we can use those limits, those ranges, to begin our analysis process. This is the most basic principles in technical analysis that I'm teaching you right now. If you have some history with technical analysis, then this is going to be very redundant for you. But for most of you, you come from a more fundamental background. And so this discussion is changing your philosophy. It's opening your eyes to something different. Okay, so let's understand this core principle. When we start to identify support and resistance, remember, resistance is where the selling pressure comes in. Support is where the buying pressure comes in. We can start to put boundaries on where that human emotion should be trading, where we expect those movements to be going. Now, this principle that you see in the screen, this is actually a pattern. This particular pattern is what we call a trading channel. A trading channel is simply a stock that's moving sideways between support and resistance in a predictable repeating pattern. That's all it is. And so as the stock rallies up into resistance, the selling pressure starts to build and it starts to sell off. As it sells off into support, the buying pressure starts to build and it starts to rally out of there. We can put this on multiple stocks. Lots and lots of stocks get stuck in channels. It happens all the time. And the principle is just the idea that the stock rallies up into resistance and sells off into support and rallies up into resistance. Now, this picture you see on the screen, this is theoretical. But all we have to do is put the real price action on there and you see, wow, that theoretical line of the stock running up and down, back and forth, in reality looks a lot like this picture that we see on the chart right in front of us. The actual data that you see on the stock chart will usually not look exactly like the textbook version, but it will be very close. That's why we study the textbook versions. And then we have to adapt it a little bit in the real world. But what I want you to understand are the textbook ideas first. And then as we start to do more and more analysis, these real world examples will start to come into fruition. And you'll start to be able to identify them as well. So you look at that stock channel on Caterpillar. Let me say it differently. You look at the price action on Caterpillar, and you say that stock has been stuck in a channel, and it just so happened that we got stuck in a channel for several months, more than half the year. Now, who thinks you can get rich on this trading pattern right here? How many of you think you could get rich $6 at a time? Chris, I think you could retire on $6 at a time if you just learned how to draw support, draw resistance, and trade this pattern. And if it was that simple, then of course everybody would do it all the time because the whole market would be trading in channels and everybody would learn this little tip. Unfortunately, patterns break. And so we're going to get into a whole plethora of variations on patterns. But right now, I want you to recognize the opportunity. The fundamental trader would look at this stock and say, my goodness, from the beginning of the year, we ended the year down 10%. That's what the news is talking about right now. The news media today, I forget who it was I was listening to while I was driving, but somebody was making the comment that the S&P is still barely in the green for the year, and that's, quote, a good thing. Bull malarkey. They missed the story. The story is that the stock market set us up to sell off some 1,500 points in the Dow Jones, and most people missed that opportunity. And now people have lowered their standards so much that they're happy about the fact that they're breaking even for the year. I'd like to cry uncle on that and say we deserve better. You can all do better than that when you learn to recognize this opportunity. By the way, what if I told you that this picture right here, the one that I just drew a square around on Caterpillar, this picture right here told us before we sold off 20%, it told us that Caterpillar was about to sell off. What if I told you that, Chris? Now, Chris, the challenge is not how do I buy, hold, and pray that it works. The challenge is how do I learn to recognize that pattern? This pattern is not that different than the channel pattern. It's just one of the variations. And so, Chris, while a lot of people would look at this and say, well, the stock's down 20%, and then it rallied and it ended the year down 10%. Other people would look at it and maybe they bought in April and they say, well, 6 months later, the stock went nowhere. I look at this and I say, well, we had a great selling opportunity up here, which you'll learn about later. We had a buying opportunity here, but in truth, we probably missed it. But this one right here, we did not. This one was a great buy signal. I'll teach you how to identify them later. And this was a great sell signal. That means we could have bought this stock somewhere around $82.50, maybe $83, and you're going to sell it as you're approaching resistance or maybe on the backside right around $87.50, maybe $88. Let's use round numbers. Let's say we got in at 83, and let's say we got out at $87.50. You made $4.50 a share. Somebody do the math with me on that. If you made $4.50 a share on a stock that traded at $82, what percentage of profit is that? That is going to be roughly 5% if my immediate math skills have not failed me. Is that about right? About 5%? Now, guess what happened? The stock sold right back off to the same place. It didn't take me a year to get 5%. It took me about half a month. Somewhere between 2 and 3 weeks. And then we sold right off to the same price. And as we rallied out of there, you had another buying opportunity. We'll just say we did the same thing. We got in about $83. Now, as the stock pulled down, you may have stopped out of the trade around $86. And so you might have made $3 a share. I'm saying might because not all of you would have gotten out. Some of you would have held through the torture. You would have come down here and missed the next opportunity to get in. So either you got out and made $3 or you held through this. If you got back in, you made another $4.50 as we rallied up here into our next sell signal. Now the stock sold off again, and as we bounced a little bit high, but again, we can enter the trade about $83 a share. This time we have the same opportunity to get out. We should have been able to pull another $4.50. So we got 5%, we got 5%, we got another 5%. We had a little bit less than 5% over here. I don't know what $3 is divided by 82, but it's probably around 4%, maybe maybe 3.5%. Then finally, we had another opportunity. We can jump in here about $83, get the same $4.50. There's another 5%. Over this 6-month period of time, there's an easy 20 to 24% profit. $4.50 per share on 1, 2, 3, 4 of the cycles. One of the cycles had less than $4.50 per share opportunity. All of them fell within the channel. All of them were a fairly predictable pattern, relatively easy to make money on. Chris, if you could learn to identify that pattern, do you think you could learn to make some serious money? Now, let's look at the other side, because the truth is, this is not the full opportunity, is it? There's more opportunity here. There's more opportunity. What's the next opportunity that happened at the same time? Well, if we know the stock's going down, there's another trade we could place called a short trade. When we sell the trade to close our position and the trade turns back down, why not short in here and make another $4 or so on the way down? Now, you may or may not have shorted the second one. You certainly would have shorted the third one, the fourth one, and the fifth one, of course, we rallied out of there. We never turned back down. So you had an extra 1, 2, probably not the second one. I'm going to say you probably didn't short the second one. You probably shorted the third one. We'll call that a 2. 3. We had another 3 opportunities to make another $4 to $5 a share. In other words, during this 6-month window of time, when the traditional investor would have said the stock went flat, or the traditional investor would have said the stock's down 10 to 20% for the year, I'm telling you that the technical trader who learned to identify the reality that for whatever reason, we get resistance up here around $88 and we get support down here around $82, for whatever reason that happens, it turns out that we can make 20 to 30, maybe 40% profit in a 6-month window just trading the stock, buying at support and shorting at resistance. Why they don't teach this to you in kindergarten, I don't know, because my business partner Josh has taught this to his 6-year-old, and his 6-year-old son has learned to do this. Everybody can learn this. That should give you some encouragement. Now, Chris, I'm going to up the game a little bit. Can I up the game for you? Can I take it to another level? What if we took this channel and we turned it on its side? Now we got a stock that's trading between support and resistance in a predictable repeating pattern, but now we're making higher highs and higher lows. You see what happens? The stock trades up, it comes down, we're in a predictable repeating pattern. It's the same channel, but now what we've got is we're making higher highs. This is a higher high than the previous, and all the way up we got higher highs and the higher lows as well. When you've got a stock that's making higher highs and higher lows, by definition, it is an uptrend. If it's making these higher highs and higher lows while moving sideways between support and resistance, we've got ourselves an upward channel. Chris, how do you think you could trade an upward channel? If you could learn to identify the upward channel, and I know you can because I'm going to show you, how would you trade this? Well, we're in an uptrend. I don't want to trade counter trend, so when we're bouncing off support, I'm going to buy. When we get to resistance, we're going to sell. We're going to buy, and we're going to sell. We're not going to trade the counter trade. We're not going to do the opposite direction. We always want to trade in the direction of the trend. But you're just simply going to be buying as you're bouncing up off of support. I think that you could figure that one out, Chris. And by the way, this principle that I just taught you, even traditional traders use it. They call it buy the dip. They just didn't realize that they were fitting right into the predictable human emotion. You see, the technical trader has had an edge all these years, for more than 100 years. Charles Dow put these principles in place more than 100 years ago. And the technical trader, whenever we come to the market, a lot of times it's almost as though we're watching the trading behavior of every participant, kind of like they're in an aquarium, and we are the observer. That means we've got a lot of money-making opportunity when you learn to identify it, Chris. Because what happens is humans tend to do the same patterns over and over. So what if we took that whole principle now, Chris, and we turned it on its other side? What if we took the stock moving sideways between support and resistance in the predictable repeating pattern, but now we're doing it while making lower highs and lower lows? Same pattern, different angle. Now we've got a stock with these lower highs. Well, there's your resistance, lower highs. Each of the lows are lower than the previous. We've got a downtrend. Lower highs and lower lows, definition of a downtrend. And we're moving between support and resistance. We got a channel. We got ourselves a downward channel. Chris, how do you think you would profit if you're going to trade a downward channel? Well, if we're going to trade a downward channel, it really goes like this. You never buy the dip. You only short the rally. You short as soon as you hit your resistance and you turn down. Right now, in the real world, in the stock market, we're starting to find some support. We might drop down one more level, and then we're going to rally. And when we rally, it's going to be one of the greatest selling opportunities that you've ever had. The first selling opportunity you had came a few weeks ago on September 19th and 20th, 21st, somewhere around there. There's a weekend in there somewhere, but right around the September 19th mark. That was a great selling opportunity. If you missed it, that's okay. A couple more selling opportunities came in the middle, and now the market's down some 1,500 points on the Dow. I'm telling you that the Dow Jones is about to rally, as is the S&P, as is the NASDAQ. And when it rallies, don't go buy the dip. Be prepared for the next sell-off. That's when we can get in here, we can short, we can buy puts. And now we're going to sell the top. Now, what if I could give you a very basic retirement plan, one that all of you could understand tonight? And I know you don't know how to master it yet. I'm not trying to get you to be masters tonight. I'm going to keep teaching you. But I'm just going to give you a very basic retirement plan. And here's how it goes. Learn to draw support and resistance. Learn to draw support and resistance. Then we're going to go apply it by finding some stocks that are consistently trading between support and resistance. And, Tim, here's your plan. You're going to buy at support and you're going to sell at resistance. Is that a plan that is simple enough that most of you think you could figure that one out? I mean, this is not rocket science. They've told you on television that it takes a lifetime to learn this, and it does not take a lifetime to learn this. Your financial planners told you that you need to pay them lots and lots of commissions and let them deal with it, and most of them have never placed a trade. This is real. What I've taught you so far is a textbook version. Let's go look at some real world versions because the real world is never going to be quite as tidy as the textbook. So let's take some examples. Look at John Deere. This is current. Look, this is October 2014. You can go pull these charts up. Does this look like anything that you've seen recently? Anything that we learned about tonight? Does this look like a downward channel, Kenneth? Yeah. So, Robert, if you were considering trading John Deere, what kind of an opportunity are you looking for right now? I think the ideal opportunity would be get your eyes looking right here and ask yourself, when am I going to turn back down? And when I turn back down, I think that might be a really great opportunity to short or maybe buy some puts or use another bearish trade that I'll teach you about. And to ride this sucker down to about 79 or 80 bucks, and that's about the time that you should cover your position and hang on because it's going to bounce again. Does that look like a trade that you guys could figure out how to do with a little bit of practice? Absolutely. This is real world. This is not theoretical. This is the real world. Let's take a look at Disney. Disney's been in a fantastic channel for over a year. Now, what do you think has happened? This has been an ascending channel, an upward channel. Been happening since September of last year. Before the upward channel, what happened? This was a sideways channel that we had between March and September. Now, as the trade starts to rally, it comes back down to support, rallies back down to support over and over and over again. What do you think has just happened here, though? This is a current chart. Edmund, what would you do with the trade now? Now that we've started to sell off and that we've broken these support lines that you don't even know how to draw yet, you can probably conclude what we should do. We should either ignore the trade or set up for a bearish trade. I'm going to teach you how to be making a lot of money on this trade as a bearish trade, but based on just what you know from tonight, the pattern has broken, so you're not going to buy it. You're looking for a bearish pattern to get established. I think most of you could figure that out. I happen to believe that you're that good, Catherine. What do you think, Catherine? Could you do this? I think you could. Now let's take a look at another trade. Let's look at eBay. This is the real world. This is a current, almost a current chart. Was it? Yeah, this is 2013. This was last year. No, let's see. I'm confused. January 2014 to January. That must be 15. This is a current chart. Forgive me. I got confused with my dates across the bottom. Take a look here at eBay. eBay was in a nice sideways channel from September, approximately 2010, in through September, the end of the year, basically 2011, the real world. Between January 12 and January 13, we had an upward channel. And for basically the last year and a half, we've been trading sideways in a sideways moving channel. Does that look like something we've learned about tonight? Now, the truth is, ladies and gentlemen, that these patterns are all around the market. And of course, when I bring out all the examples, it looks really easy because I've pulled them out. But the truth is, you don't necessarily have to go out and just guess. You don't have to say, well, where am I ever going to find a stock that's in a channel? Stocks in a channel will appear when you do the right analysis. How many of you have ever been solicited for one of those scanning softwares? And these scanning softwares will say, we'll scan the market and we'll give you the right opportunity. That's a very limiting view. What they'll do is they'll scan and they'll say, well, we found a head and shoulders pattern and you should take this trade. Or we found a channel, we'll take this trade. What if I told you I got one better? What if I told you that all you need are a handful of stocks? Maybe 10 to 15, maybe 20 stocks on your watch list. And if you just chart those stocks with the tools that I'm going to give you, these channels will appear before your eyes. These head and shoulders patterns that you've not learned about yet will appear before your eyes. And all you have to do is stay current with the stocks that you're watching. You don't need to spend hours scanning. You don't need to spend hours poring over fundamental data or guessing what's a good trade. You just need to identify the human patterns that have existed and start to track with them as they continue to become self-fulfilling prophecies. That would be a different way of approaching the market, wouldn't it, Chris? That's exactly what I'm going to teach you to do. What I'm going to teach you to do is to take a stock that you've never looked at, and in a matter of 15 or 20 minutes, you're going to be able to chart that stock from scratch. And if you just keep checking in with it, maybe once a week or so, you'll be able to make some adjustments that you need if there are any to be made. And you'll be able to have a pretty good idea moving forward of what the price action of that stock should be doing, the boundaries of where it should be trading and where it should not be trading. I'm going to teach you to do that. Now, to get there, what we've got to do is we've got to learn about charting. The end result is what I just showed you. The end result is you start to get patterns such as a channel, such as an upward channel or a downward channel that you can trade. But to get to those patterns, to be able to identify them, it's not as simple as just saying, well, where's a stock that trades a channel? That's the wrong question. That's the lazy man's question. The right question, the question that I ask, the question that I start every trade with, is where do the buyers and sellers like to buy and sell this stock? And if we can identify those price points, we can chart our stock. And once we've charted our stock, what we will find over time is the patterns start to emerge, they start to appear, and the opportunities will find themselves in your lap. Now, this style of trading is counterintuitive to many of you because human beings are predictable, and one of the predictable things of human beings is they are impatient. How many of you are a little bit impatient? How many of you are sitting there tonight thinking, oh, just give me the money already. Show me how to make the money right now. Yeah, human beings are freaking impatient people. Some of you are writing in, yes, just give me the money right now. Robert, I knew it was you. I knew it was you. Here's the truth, ladies and gentlemen. People are impatient, and so what people want to do is they want to go force a trade. The type of trading I'm going to show you will benefit you if you will learn the gift of patience. There will be days, weeks, possibly months where you actually don't have a great trade. And it's going to be everything, you're going to be fighting everything inside you to not trade because you want to go find some money. The name of the game is patience. Let the trades come to you. It's a lot like fishing. Fishing requires patience. You can go catch a bunch of bluegill, but bluegill are not the big fun sport fish. If you really want to have fun catching fish and you want to do it with all the big sport fish, you've got to have some patience. You put your bait out there and you let the fish come to you. Trading is not that different. Whenever we start to become really great technical traders, the ideal way of trading is to chart your stocks, have a handful of stocks that you watch, and keep up with them. And then what's going to happen is you're going to go through several weeks sometimes where the stocks are kind of stuck and they're not doing anything. And then they're going to start to shape up. And one stock may shape up and give you an opportunity, and 5 other stocks have no trade. And then one day you may get into an opportunity like we had 3 weeks ago. 3 weeks ago when I was setting up our power trader trades, I said, people, this market's about to get really exciting. Look at all these great trades we've got. And it just so happens that right now we've had phenomenal trades left and right sitting there. But it's not because we force them. It's because we wait for them. So if you were to write something in your notes, write down this little phrase: patience is my friend. More importantly, not only is patience your friend, patience is also your gift. Patience will allow you the opportunity to not have to sit in front of your computer all the time. Most people think that to be a good trader, you got to sit in front of your computer all the time. That's a myth. You don't. You need to chart your stocks, and you can check in on them once a day or every other day. And then when the trades start to shape up, you can set the computer up to actually do the hard work for you. So, in the time that we've got remaining, I've gone a little bit off script. Forgive me for going a little bit long. In the time we've got remaining, I want to introduce you to the price chart and start showing you a little bit about charting your stock. And then we'll pick this up in another class, and I'll show you more detail. In the last class, we started asking the question of what is a price chart, and I gave you this definition. I said a price chart is the plotting of the past price performance of a stock for the purpose of analyzing market behavior. That's really all it is. A stock chart or a price chart is just taking the past price performance, putting it on a chart so that we can analyze the market behavior. And when we talk about market behavior, we could just as easily change this word to human behavior. Now, with that in mind, you need to understand that this price chart is going to be your primary tool. Every technical trader relies on their stock charts because the stock charts are the primary way that we can analyze human behavior. So, let's review quickly what we learned in the last class. In the last class, we learned that there's 3 types of charts. There are line charts, bar charts, and candlestick charts. The line chart is the most basic chart. We're going to simply draw a line connecting the dots. And if you draw these by hand, you might even sing the old song, Connect the Dots, la 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 la. But that would only be if you drew them by hand. I use a computer. All right, the bar chart is the next type of chart. This is going to be drawn with the open, the high, the low, and the close. Of course, we draw these left to right. On the left side, you've got the opening price. You got the high price of the day. You got the low price of the day. On the right side, you've got the closing price of the day. And then we just plot all of that across the chart. The bar chart is great, except for when you put it onto a screen with a bunch of other little bars, they all kind of squish together, and it makes it a little difficult to read. So the Japanese candlestick chart is the preferred method of charting. This is also going to draw the open, the high, the low, and the close. But the difference is the white candles are going to represent a higher close than open, and the black candles are going to represent a lower close than open. So we've literally got data in black and white. It's that simple. It's in print. It's easy to see. Now, as I mentioned in the last class, sometimes you'll have a charting software that will color these candles green and red. I do not like that, but if you like it, then more power to you. I personally don't like it. It drives me crazy. I like the black and white, most importantly because the white candle traditionally actually is what we call an open candle. It's transparent, and the background's white, so you see the white background. All right. Now, with that as a quick refresher, how do we start drawing the right lines on the chart so that, Chris, you can go identify support and resistance, and you can go identify some channels? Well, here's how we do it. We start with a line chart. Remember, the line chart's the most basic chart. It's the one that simply draws the line connecting the closing prices. Next, we're going to draw a line at the highest point on the chart and the lowest point on the chart. The highest point and the lowest point. I call that framing your chart. Next, we're going to come behind it and we're going to start drawing a horizontal line everywhere that we've got at least 2 turning points. Ideally, we're going to have 3 or more. And if you have a price point that has a whole bunch of turning points on it, you need to know that that's the most important price point. The more times that a stock hits a price point, the more valuable it is. Once you've drawn your chart with your line chart, now we will flip over, we'll look at the candlestick chart, and we'll get some more confirmation. So let me show you how this works. Take a look at this chart right here. And the first step is we're going to draw the extreme high and the extreme low. Why are we drawing the extreme high and the extreme low? What it does is it brings our focus into the price action. We start to limit what we were looking at. Instead of having all this random price on the screen, we're starting to bracket this, frame it, get it into a picture that we can start working with. Now, the next thing we're going to do, I typically draw from the bottom up. You can draw from the top down, but I typically go from the bottom up. And you're just going to raise your line until you start connecting at least 2 points, ideally 3 or more. And the more times that a stock hits a price point, the more valuable that price point is. Now, whichever charting software you're using, if you're using Trade Navigator or TSU Charts or TradeStation or whatever you're choosing to use, all of those charting softwares are going to have a way that you can draw a horizontal line. And what we're doing here is we're just establishing a grid. I'll spend more time working on this with you, but I'm just giving you an introduction here tonight to drawing that horizontal grid through which the stock price will typically trade. Now, here's some notes. Just some additional notes for understanding this, then we're going to go over and we're going to go do one together. A stock can touch a line from either the top or the bottom. It can be either support or resistance. It does not have to be one or the other. You want to start with at least 2 to 3 years of time on your chart. I prefer to start with a daily chart. You can go up to a weekly chart if you want to, but always end with your daily chart. Excuse me. All right, there's some notes for you. I'm going to give you a second to copy that down while I drink some water, and then we're going to go chart some in the real world. 1 second. All right, let's go move forward, and let's go do one of these in the real world. If you miss any of these notes, they are in your notes. You can download those. You should have gotten the email, and you can always go print that off, and if you miss anything, you can always go back and do that. All right, let's get over here to Trade Navigator, and let me go find a stock. What's a good stock that some of you guys like to trade, one that probably I don't look at that much? Let's try to get one that's not on my top 10 here. And we'll go over and chart one. Do I have any requests from the class? Okay, so we've got Boeing and Coke were the first 2 that came in. Let's try. Either one of those should be pretty good. So we'll start here with Coke. And here's what I'm going to do. Are you guys? Nope, you're not seeing my screen. Hold on. What's going on here? Let me share this screen with you. You guys seeing my charts yet? There we go. Okay. So here's what we're going to do. What you're seeing on the screen here, I'm using Trade Navigator, by the way. You don't have to use Trade Navigator. You can use whichever charting software you want. It just so happens that I've been using Trade Navigator for a long time. And since I've been using it for actually over 10 years now, I'm very comfortable with it. And so this is the charting software that I use. We also have TSU Charts, which is just a white label version of the Motive Wave software. We've got that available on our website. If you use Thinkorswim, you can do all of this. If you use TradeStation, you use NinjaTrader, whatever you choose to use, you can do all of this. Here's what I want to encourage you. Get a good charting software. FreeStockCharts.com is free for a reason. It's cheap. And if you want to be a good trader, don't be cheap on your tools. So get yourself a good charting software, whichever one you choose. The best free broker software is Thinkorswim. That's the best one that's free. The Options Express charting is okay, but it's certainly not what you really want to build your portfolio around. Options House charting stinks. It's lousy. And so most brokers are going to have lousy software because they're brokers. Some exceptions are companies like TradeStation, Thinkorswim, some of these companies that have built the brokerage around a platform. But I use Trade Navigator. So let me give you some tips here on Trade Navigator. You're going to look up here in the middle of the screen, and you're going to see that there are 3 buttons up here that we will rotate through. I'm going to zoom in first. There we go. And if I click on this button, you're going to see there's your bar chart. If I click on this button, you're going to see there's your candlestick. And if I click on this one, you're going to see there's a line chart. Now watch this. I'm going to show you a better way to do this. I use a key called B, as in bar. And what happens is when I press the B key, it cycles between these bars. You get this green and blue and red one. That's called a Bollinger bar. I've been asking them for years to get rid of that from the cycle, but they don't. So you have 4 in here. You got the bar chart, the candlestick, and the line chart. And then you got to push through the Bollinger bar, and then you're back to the bar chart. But this is the fastest way to change your view, and that's what I do typically. I just press the B key. Okay, so I'm not actually pressing the buttons at the top. You can press them at the top of your mouse, or you can press the B key. Now, the next key command I want to teach you is plus and minus. Okay? When you use plus and minus, you can zoom in or zoom out. If you see me moving quickly in and out, it's because I'm using this key command, plus and minus. Okay? So that's the next key command you need to know. Now, the next thing you need to know is you're going to look up here and you're going to see a little tool called crosshairs. And when you select that tool, if you use the key command, Control plus you click with your mouse, it will snap a horizontal line. Uh-oh, what did I just do? I did something wrong. Hold on. I think I hid all my annotations. I need to delete that and unhide that. Sorry. All right, let's control click again, and there you see there's your horizontal line, and you can just go up and down. That's how I do this so quickly. I use a key command. The alternative is to mouse around, and mousing around gets very slow and cumbersome, so I like to use these key commands. So control plus click. Ooh, sorry about that. Control plus click will get you your horizontal line. Plus and minus, zoom in and out. B, as in bar, will toggle between candlesticks, your line chart, and your bar chart. Now, if you're using TSU charts, I had them set those key commands up the same way. You can use B. I think on TSU charts, it's command click instead of control click. And plus and minus zooms in and out. All right, so what we're going to do is we're going to zoom out. And we're going to get a lot of data here on the screen. Let me resize this. We're going to get a lot of data on the screen. And we're going to go back about as far as we can go. Now, I don't trade Coke. I haven't traded Coke in a long, long time. So I'm doing this basically from scratch for you guys, which is awesome because now you can watch how fast I can do this. And the first thing, if you remember from our list, what we want to do is we want to draw a line at the very top. Before I do that, whenever you look at Coke, what's the first story that you sense whenever you see this thing? Do you feel like, oh, this is random? Do you feel like, oh, that's just a big bullish trend? Do you think you should buy it? Do you think, oh, this thing's about to reverse, I should sell it? What do you think? Leon thinks it's in an uptrend. Okay. Anybody else got uptrend? Uptrend is what I'm seeing from most people here. Okay, most of you are just seeing the uptrend. Great. All right, some people would see randomness. This is a pretty well-defined trend, so the uptrend is the obvious part. Let's draw a line up here at the top, and I'm going to come down here to the bottom and draw a line as well. Again, I'm on the daily chart. And all I've done is I've just taken the very bottom point and the very top point. Now, what I'm doing is I'm starting to bring our focus in here. Now, I'm going to start at the bottom, and since we do have such a defined uptrend for a long time, most of our price action is going to be over here on the right side. But what I'm going to do is I'm going to come up here, and everywhere I can connect at least 2 dots, I'm going to draw a line. Well, I can do that here. Okay, let me bring your attention to it. You see, I got 1, 2, 3 right there, and then I got a fourth one right here. So I've obviously got some support that happened here at $17.20. All right, I'm going to keep coming up. I do this from the bottom. You can do it from the top. I'm going to keep coming up. Right in here, there is some support at $18. Now, because this stock is fairly cheap back here, your support lines are going to be very close to each other. Okay, as we get more expensive, the lines will separate. You'll have, usually a few dollars between them. Now, right up in through here, I've got some resistance that took place right around 1936. All right, now let's keep on coming up here, and all I'm doing is scanning from left to right with my eyes, and I'm just drawing a line connecting the dots. Now, sometimes they're going to be perfect connections. Sometimes they're going to be pretty close, but not exact. But you're wanting to draw a line where you capture the majority of that turning point and that price action that was turning in that location. Chris, if you'll learn how to do this, what you're going to find is you will not get caught off guard from a major market turn like you have been recently. Okay, and I'm only picking on you, Chris, because you voiced some of your recent losses. Now, when you get into an area like this has a lot of congestion. And I could draw a lot of lines in there. I've done a lot of this, and so I know where the main turning point is, and I can look kind of between the lines, and I can tell that right there in the middle is really the main turning point. So I'm going to put a line right in there. That's really the main turning point. But oftentimes you'll get congestion like this, and you'll have a lot of turning points in the same spot. So now all I'm doing is I'm just drawing my turning points, connecting the dots, connecting the turns, the support and the resistance. And what I'm hoping that you're starting to see is, my goodness, it's almost like Coke has been trading through a grid. Now that you look at this chart with my lines on it, I know sometimes people will say, that's a lot of lines. People will say, well, if I draw that many lines, it's destined to touch a price point. But it's not true. I could draw some lines, just randomly, and they wouldn't necessarily touch a turning point. What you see here is you see a fairly even grid. Because the stock is not that expensive, it's a $42 stock, you're going to notice that the grid is a little bit tighter than it would be if, for example, we're looking at Netflix, which is several $100s a share. But you still have a grid. And what you also should be noticing is, if you look at this thing and you look at the grid, that the stock seems to have some behavior that's taken place in through here. We seem to be trading to the same turning points over and over. How many of you can see that picture? Okay? The same turning points happen back to back, over and over. And there's an area in here where we had a lot of congestion right there. Well, that became support right over here. Okay, now I could also draw some diagonal trend lines on here. That's not really the lesson that I'm into tonight. I'm going to teach you diagonal trend lines at a later point. That's going to be coming up in a couple of classes. But we do have some diagonal trend lines as well, and that's how we would get into the trend definition. I'll save that for a later class. But what I want to do right now is I want to continue this discussion on the basic grid of support and resistance. Chris, if you had this grid, if you had it drawn for you, and let's say that we were to zoom in here on the Coke trade, Chris, would you have wanted to be buying, if you had this grid, Coke up here at 44.50? That's probably not a place that you would have wanted to be purchasing. Chris, do you want to buy Coke at 42.56 where it closed today? Well, not yet. Chris, what if it hits down here about 42.17 and it makes the turn to head higher? Would that be the place that you might want to buy Coke? That's probably about the place you'd want to start buying a Coke, and maybe you could even find a can that says share a Coke with a Chris, right? Maybe. It would be in the direction of the primary trend that we've been trading. That would be a continuation of the bullish trend, and it would make sense because you're bouncing up off of support. Now, Chris, the challenge that you're going to have is to ask the question, how do I know that this stock is going to continue this grid? Is anybody wondering that right now? How do I know that this stock is going to continue trading through this grid moving forward? So we're going to test that. And the way we're going to test that, well, I skipped a step. Forgive me. Please forgive me. I forgot a majorly important step here. We need to look at our candlesticks. I got so excited about teaching Chris that I forgot. We need to look at our candlesticks. So the reason we look at our candlesticks is the candlesticks give us the open, the high, the low, and the close. So we get the intraday data. Okay, and the reason I'm doing this is I want to confirm some of our turning points. This particular stock, the reason I didn't even immediately flip to candles is because it's so clean. This is a very well-disciplined stock. There's a couple of examples in here that we can look at. And I'm going to toggle back and forth between the line chart and the candles. And notice how these areas that I've circled, how it brings some of those support levels into clarification here. And all we're doing is we're using the intraday data of candles to bring some added clarity, added confirmation. Usually candles will not be quite as clean as a line chart. The line chart is much cleaner because it's just drawing that sharp angle off the turning point of the close price. But the candlestick will often show us some extra information, and so it's good if we're charting a stock for the first time to take this look. All right, so I've charted this well, and I hope you see that principle there. Now, going back to the question that I was moving towards with Chris, in theory, if we've drawn this grid, then you want to be able to use it in the future. But how can we know that this grid is going to be valuable in the future? After all we're doing is looking at historical price behavior. So the way that we're going to test this is, it's a hypothesis that if it works in the past, then it should work in the future. And so what I'm going to do is I'm going to do a little exercise that we do whenever we chart a stock from the beginning. And you can look at this and you can see, okay, on the left side of my stock or my chart, I've got about 2007 data. On the right side, I got 2014. So I'm just going to scoot this over, and we're going to go look at data that we haven't seen before. So we're going to scoot the chart over. And now on the right side, you see 2007. And now we're all the way back here to 2000. Look at that. So we can come all the way back here to the year 2000. And these lines that we just drew from the future, it turns out worked quite well, stunningly well in some of these cases, all the way back to 10 years before, 2000, year 2000. Well, let's keep going. Let's see how far we can go with Coke. Okay, so if we come on over here, now 2000's on the right side. Look at this. We can go all the way back here to 1997, 1996. This grid has been in play for all of these years. Now, if Coke and the grid that we've drawn for Coke has effectively been in play since 1996, moving forward, the question that I've got for you, Chris, is if I zoom in here and I look at my candlesticks, Chris, do you think that these lines that we've drawn are going to be good enough to help get us through maybe November and into December? And if we keep looking at these charts maybe once a week or every other week or so and adjusting anything that needs to be adjusted, do you think we can keep these charts updated? And do you think we can keep that trading behavior fairly well charted? The answer is yeah. We're not trying to predict 15, 20 years in the future. We can go back and look at 15, 20 years of history, and it works exceptionally well. I'm not trying to predict what's going to happen in the year 2020. I'm just saying that if it has worked for the last 15 years, it's probably going to be good for the next 2 or 3 or 4 months. And that's the trade that we're going to go take. We're going to go take this swing. If, by chance, Chris, Coke starts to turn up, then we might have a buying opportunity where we can buy in somewhere around $43 and make about $1.50 a share, and it's probably only going to take us about a week or two. If Coke starts to fall down through support, our next target's going to be down here, and now we're getting into another lesson. So I'm not going to get too far into that lesson. Notice that I don't have to sit here and talk about the price-earnings ratio. I don't have to sit here and talk about who's running the company or how effective their new marketing campaign is. All we're doing is looking at the human behavior. And we get all the information that we need. Now, what I've given you tonight is the beginning. I need you to go practice this thing. So here's your homework for the night. And then we're going to pick it up from here. I need you to go over to your charting software. If you've got TSU Charts, great. If you got Trade Navigator, great. If you got another charting software, great. I need you to go pick some stocks and start drawing some lines. Start practicing this. It might require, if you've never charted before, it might require that you watch some videos on how to use your particular charting software. I'm not going to have a class teaching you to use the software. I'm going to expect that you do that homework on your own. But get over to your charting software, pull up some stocks, and see if you can find some channels by drawing some support and resistance lines. You're going to find that there's a lot of them out there. All right, and then what we're going to do in the next class is we'll pick it up from here, and we'll start talking about orders and actually placing these trades.